Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at our Options Play. And last week, the Federal Reserve embarked on its first rate cut since 2020. And markets largely have reacted fairly positively to that overall news. And we find ourselves in a position where some equity markets are back at all-time highs. And I think the question for most investors at this point is really along the lines of whether they believe equities has the momentum and legs to continue this upward trajectory, or are we starting to reach levels where there is some concern with regards to equities, especially around valuation? We were already trading at about 21 times forward earnings on the S&P 500 prior to the Fed meeting. Now that we've had markets react positively to that, we're seeing that valuation get stretched even further, which for long-term investors certainly provides a more challenging environment to find stocks that are reasonably priced to buy. So let's take a look at the charts in terms of where overall equities stand, what the other markets are telling us to inform our views from a macro perspective. So on the S&P, we've seen this 5650 all-time high was broken here at the end of last week. This largely is constructive here for the S&P 500 to make a new high here. However, one of the things that we do want to note here is that there's some level of negative divergence, higher highs in price no longer being confirmed by higher highs in terms of momentum, showing us that this breakout here on the S&P 500 is showing some levels of exhaustion, and worth noting for equity investors who are thinking about buying this and chasing this to even higher levels. And when we look at the NASDAQ 100 index, this is really what's interesting is the fact that while the S&P has managed to break out to new all-time highs, the NASDAQ 100 not only did not manage to break out to new all-time highs, did not even break prior resistance. This is not a particularly good sign for the NASDAQ 100 and the stocks that are leading the markets higher here, given the fact that even when in an environment where interest rates are declining, and we'll kind of discuss that here in a couple of minutes with regards to the actual change in interest rates. But even in this environment, stocks that are trading at a heavier valuation, which typically tend to be more sensitive to rate cuts, are not performing in this type of market environment. So the NASDAQ 100 actually underperforming the S&P 500 as a result of the Federal Reserve's meeting here last week. And then you get a very similar picture here on small caps, IWM. We were basically back below recent highs around 225 here on IWM, continues to trade more in a range-bound motion rather than a continuation higher here. So if you look overall across the board in terms of equities, it's not particularly a strong signal that we're currently seeing. So let's take at some of the other markets to kind of get a better gauge here for this. If you look at the RSP equal weight S&P 500, we did manage to break a new all-time high on RSP, which is indicative of the fact that the rally has started to broaden out a little bit, which is overall constructive for the equity markets. And we'll continue to see kind of these specific major indices and how they evolve over the next couple of weeks. But largely, you just have the S&P 500 dragging the markets higher while the rest of the market kind of lags behind a little bit here. Now, when we look at growth versus value, we continue to see that despite the fact that over the last nearly year or so, growth has outperformed value, but over the past few months, we've seen significant outperformance from value over growth here. And this is something that I do expect potentially still to continue, especially as we've seen that small caps are breaking out to new recent highs. That's something to consider with regards to the overall picture for equities. We do have gold continuing to rally here, and that has provided a bit of support here for commodities. We've seen commodities now for the second straight week continue to perform relatively well, not as well as equities, but certainly giving coming back a little bit from what was a much dire outlook here for commodities overall, and just demand for commodities like oil and base metals. And it's really just gold that's dragging the rest of the markets, the rest of the commodity markets higher here. So commodities you can see is approaching a major resistance level. These are some levels to pay attention to, especially as gold starts to be within spitting distance of our longer term target of 2750. So this is something to be aware of with regards to um, where we are with gold and how that sits within the broader context of kind of what our views here for commodities are. Now, high yield corporate bonds continue to rally higher here. This is one that's interesting because the high yield corporate bonds, which give us some indication of concern that the market has with credit risk, uh, is showing the exact opposite of what we would typically see in a more in an environment where consumer spending and even economic output from a manufacturing and economic perspective is starting to slow down. We continue to see kind of this gauge show a lack of fear from investors for, concerns around a credit risk. And this is something that, like I said, we're starting to see that creep into the data, both in terms of the labor data. We've seen multiple months of soft labor data. Um, Consumer spending data so far has remained fairly resilient, but there are some signs that consumers with the significant increase in credit card debt over the past 6 to 12 months is becoming more selective in their consumer spending. And that is something that's going to have some ramifications for some specific sectors, and we'll take a look at that here in a couple of minutes. Now, if you look at the VIX here, we did manage to pull back below the 16% level on the VIX. Now, from my perspective, with the S&P 500 at all-time highs, but the VIX not really retreating enough to justify the all-time highs in the S&P 500, suggests that there is further disconnect between what the technicals and the charts are showing you versus what the fundamentals are starting to look like, and that divergence creates opportunity. The question is just how often are you going to be able to trade that specific opportunity? But VIX, really showing us that from a positioning perspective, investors are that investors have a bit of angst, if you will, as equity markets return back to all-time highs. If you look at the 10-year yield, we climbed back above 3.8% despite the fact that Federal Reserve embarked on a 50 basis point cut. And this is really reflective and telling, in my opinion, and part of why I believe the Nasdaq 100 is not performing as well is a result of the fact that funding rates, long-term funding rates, have actually risen after the S&P 500, after Chairman Powell's testimony last week. This really reflects kind of what investors believe the cost to borrow will be in the future, as well as something to consider given the fact that this has ramifications for valuations on equities more so than anything else. We see the sell-off here on TLT, which kind of corresponds with the increase in the 10-year yield that we've seen. This remains on an upward trajectory here, where the 50-day moving average provides potential support here. So we are very close to those levels. This is worth paying attention to as potentially an opportunity to gain some further exposure in treasuries here. as it kind of declines back to that 50-day moving average. We have seen the dollar bounce off this major support level at 100. We've been talking about that level for what feels like a few months now. We've reached that level here, but we've also bounced off that level. And that, in my opinion, for the long run, provides more of an opportunity to add some short exposure for the US dollar, especially as we sort of consider as we kind of consider that the Federal Reserve is on a path of cutting interest rates, and the US dollar will likely see some further weakness and potentially break below that $100 level here. But in the short run, we're seeing a little bit of support for the US dollar as the 10-year yield rises. But that rise in yields, the rise in the US dollar, I think will be likely short-lived. So further rallies here into that 102, 102 and a half level, which is around the 50-day moving average, becomes opportunities to add some bearish exposure in the US dollar. Gold, as you can see, continues to march on higher here. We closed at 26.50 yesterday. Our upside target for gold is 27.50, so we're now within spitting distance of that specific trade. And this is really driven off of kind of safe haven buying as investors become more concerned around the shape of the U.S. recovery. I think this is reflected in both kind of price in gold as well as kind of where the VIX is priced right now, given the fact that given the fact that we're continuing to see pressure here from the U.S. economic data perspective, that safe haven buying remains in demand here at the moment, and I think provides the support for gold to resume that move up to 27.50. And then oil, we've seen oil kind of trade back up to that $72 level. And just on yesterday's price action here, we got rejected at that $72 level. That certainly provides some more bearish outlook here for both oil and well as oil stocks. And we'll take a look at one of those oil stocks during our trade ideas session here for today. And then in terms of sectors that I think are worth paying attention to here, consumer discretionary is definitely the first one I think is worth paying attention to. We've had this breakout here on XLY above that 195 level. This is fairly constructive here for both for a consumer discretionary on both the absolute and relative chart. You got the breakout on the absolute chart. You got the breakout on the relative chart here. So we are anticipating that consumer discretionary will be one of the sectors that will perform in this market environment right now, where we are looking for the U.S. consumer to, at this moment, remain fairly resilient. The next one I want to take a look at is industrials. If you look at industrials, similar type price action to consumer discretionary, breakout here on both the relative and absolute chart. You've got that breakout here above that 130 level here on XLI, providing some further upside potential. We have consumer staples that I think is worth paying attention to. So consumer staples, having played a bit of defense here over the last few weeks, have started to lose some of that defensive nature here for consumer staples. You see the fact that the sector has largely traded sideways. However, if you look at the relative chart here, as the staples trade sideways, is losing a fairly significant amount of relative ground to other sectors. So we're seeing consumer staples start to lag behind. We're seeing that both on consumer staples as well as healthcare. You see the relative performance here for healthcare remains quite poor here. Basically, as we're trading sideways over the past month or so with healthcare, that sideways motion is turning this into a sector that's starting to underperform. Now, healthcare has underperformed for quite some time, and this very well could just be a continuation of that underperformance that we've seen here out of the healthcare sector. And then lastly, what I want to talk about here is the real estate market. Real estate, as you can see from a charting perspective, has continued to break out higher here, but I do want to warn investors, look at the relative chart here, meaning while it's breaking out to new highs, it's not really keeping up with the rest of the market. And for those reasons, even in a lower interest rate environment, we're not seeing the support here for some of these real estate stocks. And it's becoming a bit of a buy the rumors, sell the news type of event where anticipation here for the rate cut and big cuts here have sort of started to be tamed a little bit. And the bond markets are now pricing that 10-year yield about 10 basis points higher than where they were prior to that announcement, when the announcement was a 50 basis point cut. So that, very much I would say might have surprised a lot of investors. Definitely worth understanding that dynamic before entering any new trades for today. Okay, so let's switch gears a little bit here to some of the ideas that we are looking at here for this week. First one I want to bring up here is Shopify. Now, we've talked about Shopify over the past couple of weeks, but I do want to point it out here again. You have Shopify that recently broke out here above that $67 level here, 67.5. We broke out above that level, came back to test that level of support, and has continued to move higher here. So we're just sort of reaffirming our bullish call here on Shopify from a few weeks ago. And, both internal and external views so far into this trade is looking quite strong here. And our expectation is for Shopify to regain that $90 upside target at the moment. The next one I want to take a look at here is Verizon, which is probably not on every investor's radar, but as you can see over the past 6 or plus months or so, it's been trading in a range between, call it 38 and 42. Recently broke out of that range here. So this is why I want to pay attention to this, because you've got the breakout here over the last 6 months. So far, about a month into the breakout, or rather 3 weeks into the breakout, these levels are still holding, those support levels are still holding. And from a valuation perspective, Verizon trades at a small discount to its industry, about 15 to 18%, despite having risk metrics and profitability metrics that are very much in line with the industry. So the fact that it trades about an 18% discount represents a little bit of upside here for Verizon Communications. The next trade I want to take a look at here is AbbVie, a healthcare stock, or rather biotech stock. As you can see here, after what has been a fairly substantial move here from about 155 to just shy of 200 in the span of about 3 months or so. That's a pretty significant move from a percentage perspective. But over the last month or so, nearly 2 months now, the stock has gone really nowhere, meaning mostly trading sideways. And sideways in a market like this, unfortunately, means a license or rather it's underperforming here. And we've seen that from this breakdown here. If you look at this relative performance, we started to see that underperformance creep in here over the last couple of weeks. And that leads me to believe that there's a higher risk that the base that we've started to form above this 190 level could potentially break here to the downside. And that's why AbbVie, if you look at the fundamentals, also trades at about 20% premium relative to its peers, despite the fact that it's having growth expectations and profitability metrics that are largely in line with its industry. So the fact that it trades at that 20% discount, I'm sorry, 20% premium, provides the potential for the stock to fall by roughly 20% or so to the downside from a fundamental perspective. And then lastly, ExxonMobil. This was the energy stock that I wanted to bring up and talk to you guys about. As you can see, ExxonMobil largely trading sideways here between 120 and 110 or so. But the fact that we continue to see oil prices decline here and show weakness here in terms of oil prices, as it trades near the upper bound of that range, closer to 120, I do think that's an opportunity to potentially start selling some premium here, going into the rally here or into that 120 level here for ExxonMobil. And Exxon trades at a slight premium to its industry, about 13-15% higher than the average forward PE ratio of oil and gas. And this is all despite the fact that growth expectations for Exxon is either in line or below average. We actually have expectations for ExxonMobil to underperform, especially given the valuation metrics and the kind of the outlook that we currently have here for oil and oil demand provides kind of a more bearish outlook here for ExxonMobil. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of how we're viewing the markets from a macro perspective and give you some ideas to start off this week. With that, thank you so much. I hope you guys have a great trading day. I'll see you guys here next week.